Traders now pairing rate cut bets as yields rise across the curve. For more on this, we want to bring in Seema Shah, Chief Global Strategist at Principal Asset Management. We also have Scott Wren. He's a Senior Global Market Strategist for Wells Fargo Investment Institute. Great to have both of you here. Seema, let me start with you. Just when you take a look at some of the buying that seems to be happening here ahead of the open, it looks like we could be set for a turnaround. I'm curious, what does that tell you about the movement that we saw yesterday and whether or not the extent of that selling was a bit of an overreaction?
Thanks for having me on. Yeah, I think yesterday what we saw was, I think, a valid reaction in some sense. But I think the expectations about Fed for Fed potential loosening was very, very aggressive. Concerns about recession very much overdone. So what you're seeing now is a little bit of a kind of a reality check of maybe that actually the economy concerns are not as bad as had been expected, but you do still have some of the technicals unwinding. And you mentioned the carry trade before, that's probably got a little bit further to go. The key thing for markets, so always for anything, is the speed, the kind of the ferocity of any kind of moves. And I think that was what was damaging over the last 48 business hours. So it's hopefully seeing the yen appreciation slow down and stabilize, and that should, I think, maybe at that point start a floor, a sustainable floor for the market.
Scott, I want to get your perspective. Was yesterday an overreaction, too much of one move to the downside, given what we've seen over the course of the past couple of weeks here, the Fed really needing to take into consideration and the markets being concerned that the Fed might be behind the eight ball right now?
Well, Brad, it certainly happened quick, and we do not think we're going to have a recession. Don't think the Fed's behind the eight ball. You know, the carry trade unwind probably had something to do with it, but just, you know, the fear that gripped the market after last Friday's report that we were going to have a recession. So I think, you know, what we're trying to do, number one, you know, a big part of our job is, you know, you project the economy. So is growth going to slow a bit? Sure it is, probably for the next few quarters, probably improves in the second half of next year. So the question is what are you doing and about it? And so this morning, you know, we announced some adjustments. Basically, we're taking money out of short-term fixed income, which was a parking spot for us. We took money as the market was going up out of communication services and tech, parked it there, trying to be patient, waiting for a pullback. Putting that money into large cap, into small cap. So we're making some maneuvers here because we think you have to take advantage of this. And Sean had mentioned that 200-day moving average in the S&P. It's, you know, just above 5,000. Wouldn't surprise me at all if we touched that. So we're not trying to pick the exact bottom, but we're trying to get positioned here for what we think is going to be a better equity market between now and the end of next year.
So, Scott, given that, I'm just curious, and this kind of goes back to what Seema said there in her first answer, just the speed at which we saw the selling yesterday. What does that indicate to you just about some of that weakness, or maybe what it signals about the coming volatility that we could see over the next several weeks?
Well, I think anytime that there's uncertainty over, you know, what inflation's going to do and what the Fed's going to do about it, that plays into things. And, you know, you never know exactly how much the carry trade had on, but, you know, you keep hearing numbers, you know, 20 trillion, something like that. Well, you know, that's 4 times the daily average of global foreign exchange, you know, transactions, which is about 5 trillion a day. So, you know, when you have a lot of people leaning the same way, and all of a sudden, you know, the bottom starts to fall out. You know, it's just a get me out trade, and that's when you get these big, quick moves. People are panicked, but as long as you think you have a good feel for, you know, what's likely to play out in the economy over the next 12 or 18 months, if you think it's good, then, you know, you want to take advantage of that, and that's what we're trying to do. But the speed is always what scares people. But if you have a plan, you know, you have to kind of cut through that and, you know, execute the plan and step in when you think the time is right.
Seema, with that kind of speed and declines that we did see, does that prompt any rotation from your perspective that investors should be thinking about ahead of the open this morning?
Well, I think to Scott's point, I think the point is over the last couple of days, has anything happened which would change your perspective on where the market is going? Now, we are expecting the US economy to slow, but we're not expecting recession. We're expecting the Fed to cut rates, but again, not to have to cut rates aggressively. So from that perspective, actually, the backdrop hasn't really changed for us. So we have maintained the risk on positions, but again, really focus on some of the more quality assets, a little bit more focus on defensives. I think what's been interesting and I think a little bit uplifting through this is that one is that credit spreads have stayed fairly stable. So that adds to that idea that fixed income is there to provide that stability into portfolios. And also treasuries have rallied, and that hasn't always been the case in the last couple of years when we've had moments of panic. So I think that's been really reassuring, and it should be a good reminder that, look, you have, equities, they certainly look strong in a growth environment, but there's always a time to have fixed incomes, particularly if you have any kind of downside economic risks facing you.
Seema Shah, Chief Global Strategist at Principal Asset Management, and Scott Wren, Senior Global Market Strategist for Wells Fargo Investment Institute. Thank you both for joining us ahead of the opening bell.
Thanks, guys.